As promised, Maneesh Dangi is joining us from Macro Mosaic. Maneesh, good afternoon. Thank you very much for your time. What a change in stance by the Fed. Were you expecting it?
Yeah, incidentally, I sort of did make this prediction on your channel a week ago. And I've made this point a couple of times in last 2 months that we are closer to a Fed pivot, closer to a deep dive in US interest rates. Um, uh, People often actually sort of think that more of today will continue tomorrow, but at times, of course, these things change. And typically for rates, these oscillating variables. So I I was expecting this, have written about it extensively, and I think rates in US actually are headed much lower from where they are today. They've already rallied quite substantially, but a significant rally ahead. A US economy cannot absorb such high interest rates, and Fed had to recognize, and they did once they have begun to cite that inflation is sort of in control right now.
In that light, what is this trajectory of lower rates likely to do for our equities environment globally? A risk on, a prolonged risk on?
Yeah, so firstly for the bonds and currency, where the message is clearer, Ajay. Bonds, of course, a clear proxy of what Fed does is what US rates will do, and therefore we are entering in a very longish bond rally, and much of the pain of 2022 um, would unwind in 2024. I think on currency also, we are perhaps entering in a very longish dollar bear market, uh, and there is a small chance that dollar actually does somewhat well in US recession, but otherwise in a very very long US bear market, and that will actually help us emerging markets currencies pretty significantly. On equities, Ajay, it's sort of more nuanced. There are two parts to it. If growth actually slows more than markets sort of are baking in, then of course it hurts equity at margin. Uh, Even though lower rates per se actually improves the valuation. So there is a threat on EPS growth in US, but sort of tailwind for PE in US. So equity risk premiums can widen because bond yields have fallen, but EPS actually, which is being baked in at 10-12% increase over next 12 months, could actually surprise on the downside. So it's a bit of a nuance there, but just this variable per se, of course, is a positive news for equity.
That's interesting. What do you think it'll do to the overall flows into India in that sense? Because they were a bit skittish now with dollar weakening. What's your view of how things can change for India in terms of flows?
It could actually change. So previous decade, we've had lackluster flows. Okay, in a sense that sometimes they get hot, sometimes cold, but on average, very little. I guess if we and broadly flows track the dollar markets in terms of if the dollar is strengthening, generally it also coincides with equity in US doing better than India. I think the setup is starting to reverse. I think equities in India over next 10 years would perhaps do better than US. Indian currency would do better on a carry adjusted basis. And that means that 2020s and 2010s, sort of a dry up of flow that we saw in both bond markets and equities, would end. Not as much as 2000s of flow, but at margin actually the flows would be better. I'm more enthusiastic about bond flows in India because bond investors globally have completely shunned India over last many years. They're starting to come back. I think if the US rates drop meaningfully, as I think they will, and the currency actually behave in the manner that I anticipate, it's very likely that a significant amount of flows will return in bond markets, which in turn, be it equity or debt, wherever money comes in, it actually depresses the volatility, depresses the risk premiums, and therefore improves the return profile for investors.
Manish, but in this context, what's the best tactical trade you believe for the next 6 months? Because yes, while equities have a lot to cheer about, by no mean feat the valuations are comfortable right now. They are towards the expensive side, even if you compare to long-term averages. So across asset classes, whether it's right from a gold, crypto to debt and real estate, even others, what's the best tactical trade?
So the cheapest asset class is what stares at you and what Fed told you last night, and is bond. And therefore, uh, I've argued for it on your channel many times in the last 2 3 months that investors should get up to dial bonds. If you have an access to dollar bond market, I think massive rally ahead, even beyond what has happened in last few weeks. Bond rates are sort of down by almost 100 basis point and perhaps another 50 to 100 basis point ahead over next 6 to 12 months time. So tactically, of course, bond makes the most sense. In India, I've been of the view that carry actually, which is credit carry, is most attractively valued. But if you're a sort of a vanilla equity investor, there's nothing that you cannot cheer about right now from a macro point of view. Crude is in a decent shape, CAD has come down, currencies stopped depreciating, and finally the rate structure actually, which has been a pain for us for a long time, the US dollar market rate structure, is starting to ease. So a long duration within equity is of course, and so technically within equity, tech would perhaps purely for rate reasons would do the best in next 6 months.
My quick follow up on that point which you raised, that US equities, we may see there are tailwinds as far as PE goes, but headwinds on EPS. What equation applies for India? Do you think India EPS and PE both have tailwinds even from here?
So the local EPS, has two components. One is the investment growth, and second is commodity prices. Commodity prices would perhaps actually take some sheen off EPS, but given that there is a little bit of attraction in investment demand in India, I think independently Indian EPS could continue to chug along on the expected lines, even when US entered in recession. I'm not saying that it won't make any difference, but India has its sort of unique local ways of giving traction to EPS. On the P, it's sort of this is a common ground, that what hurts and benefits S&P 500 or US Nasdaq benefits and hurts India as well. So to that extent, the P tailwind would be somewhat similar as far as India is concerned.
I wanted to come back to the point where you said within India, the sector that looks the most positive, purely from a rate point of view, is technology. But what about financials and NBFCs particularly? Are you favoring IT even over NBFCs and other financials?
So when I say that tech is because in the context of what we're discussing over last night's decision, that if you knew nothing else in India and you get to realize today that Fed is pivoting in the wake of everyone in the market talking so hawkish for so long since 2022, what would that variable do? And that variable actually would bring steer to a long duration asset. So if you are a venture capital guy, you've had a winter of last 17, 18 months or 20 months, it should cheer you, because any long gestation projects where the cash flows are out there in distant future, should feel relieved. So venture capital, private equity to a certain extent, generally long duration equity like tech, should benefit apart from, of course, bond. What can finance do in India and other sectors do? There are many other variables to discuss, but we are discussing just the Fed moves impact on on equity market, and therefore look for the longest duration asset if this is the new news to you.
One quick last word on the asset class and the space you track pretty closely, and that is real estate. Do you see the cycle getting prolonged, which we are already in the middle of one, right? Volumes are taking off, affordability has risen. So real estate cycle may get an impetus because of late rates heading lower next 12-24 months?
Absolutely. Real estate typically tend to have these long cycles, 5-7 year bear market gives into 5-7 years of bull markets. I think we are in a bull market very, very early. I mean, real estate doesn't have a way to actually price future so well as equities do. And so to that extent, it's not reflected. It sort of comes as it happens, as demand comes up, as the inventory unwinds, real estate gains traction. I think we are in a very longish bull market, and real estate would do very well. I think I made this point on your channel many times that don't dismiss real estate and for financial savings. Real estate, if you find a decent opportunity with a decent 2-3% rental yield city center places in Bangalore, Hyderabad, Bombay, Delhi, they may end up delivering you 10, 11%, which isn't sort of dramatically different from what equity large caps would do for next 5 years. So I would urge, to have a sort of a look at even real estate, not just from an equity point of view. If you are an allocator in residential real estate, I think it's not a bad time to, even now, even though prices have risen, but I think it's a reasonable time to actually dial real estate even now.
Not a bad time despite the run up in the real estate asset class itself. Thanks so much, Maneesh, for making time and speaking with us. Appreciate you joining us.